Hi, everyone. This is Logan Hertz with Hazeltine LLC here with Peter Nelson of Nelson Insurance Advisors. Peter, how you doing?
Living the dream, Logan, living the dream.
So today I thought we'd take a little bit of a look at what some people call the true cost of term, right? I think one of the challenges we face is that most people they just ask with anything, they just ask, what does it cost? Well, until you understand the value that's being provided by what you're buying, cost doesn't mean anything. And there are lots of hidden costs as well, right? Like the sticker price doesn't give you the true cost of what you're buying. So I've said it before and I'll say it again. The most expensive products in the world are those that are free, those that are offered for free. Think about your free bank account, right? Oh, it's free. Last time I checked, the banks are pretty profitable, right? I mean, they're making pretty good money. So if they're offering you a product for free and yet they're extremely profitable, how are they making money? They're not a charitable organization, are they? Right?
No, last time I checked, and they're pretty profitable up until the point where they're not, and then we got to bail them out, right?
Yeah, I mean, you can use Google for free. You can use Facebook for free, right? All these social media platforms, it's all free, right? What about all these wonderful government services we get? They're all free, right? We all get it for free, right? So isn't that wonderful, right? We get stuff for free.
I don't
Hmm.
get anything for free from the government, unfortunately. Just kidding.
Well, you know what's interesting is that, the richer people are, the less they avail themselves of these free government services and all these free products, right? Rich people, I think, know how to manage their money pretty well. That's how they got rich, right? Um, so they don't seem to be too interested in free stuff, right? So again, we got to dig a little deeper. We can't have just this very superficial analysis. Oh, this costs more, therefore it's bad. Well, okay. What value are you getting from it? What does it actually cost, right? What does it actually cost? So the banking system costs you an enormous amount of money, an enormous amount of money. And part of the reason they're able to manipulate us is that they do it in a hidden way, right? When someone charges you a high fee, they are being transparent with you. They're telling you, here's what it costs, right? When someone gives you something for free, what they're saying is the cost is enormous, but it's hidden, right? So you don't really see that money leaving your pocket, right?
Yeah.
So yeah, um, there was something else I was going to say on that, but I lost my train of thought. Anyway, so I thought we'd go through real quick because I what I wanted to say. Well, this is what I was going to say, but whole life insurance, the value that's being provided by it is so much more than the numbers on the page. What everybody obsesses over is, okay, there's the death benefit, all right, and then what is the internal rate of return on my cash value? And everyone just obsesses over that because that's the concrete, tangible thing that you can see, right? But one of the things that makes whole life insurance so beautiful as an asset is how it makes all of the rest of your financial life so much better, right? It optimizes everything else you're doing. It protects you. It does so many different things for you that aren't reflected in the cash value, the numbers on the page, right? Whereas with term, it is pretty simple. You pay a premium in, you get temporarily some death benefit protection, right? So it is pretty straightforward. There's not really much else to it. There's not really much other benefit to it, unless we're talking about convertible term, especially convertible term with living benefits, where there are, it's a great product. I still would say it's a temporary solution like all term is, but it sets you up for future success and it protects you in more ways. It protects your insurability, right? It protects you if you have some chronic or critical illness. Okay, now you have the option to convert, right? So convertible term, I think is great. Okay, but if you're
Absolutely.
just going to buy term, you should ask yourself, what is it really costing me? Why is this product so much cheaper than a whole life, right? If you were providing anywhere near the same amount of value, it'd probably be somewhere around the same cost, right?
Right. And I think, one thing I always like to talk about is Penn State, where I attended school at. They did a study some years ago and they found out that less than 2% of all term policies ever pay out. That's not to say that term doesn't have a place. We both, you know, love term. But I say it this way. Think about this. If you owned a casino, right? And you knew that you were gonna, for everybody that came in and made a bet, you were gonna win over 98% of those bets. You would take as many bets as you could, right? So that's term in a nutshell in a way. Not to say it's bad, and I have only had one claim in 22 years of writing term life policies, but that one claim was for north of $1 million, and it was powerful. So there is a place for it, but it's probably not going to pay out. People are either going to let it lapse because they don't see much value in it. They're going to convert it, right? Or the term's going to expire. And maybe they decide not to, get another one, or maybe they're not insurable anymore, right?
Yeah, the question as always is as compared to what? As compared to what? So you look at the money going into term. Well, what could that have money done for you if you had deployed it elsewhere? Right? There's a lot of things to consider. So all the hidden costs. So with that in mind, I'm going to pull up this little calculator that I have here, and we're going to take a look at some thought experiments on the true cost of term. So here we have a husband-wife couple. They're both age 35. They're both very healthy. Okay. In this case, the husband earns the income. He earns $100,000 a year, which means his human life value is at least 30 times his gross annual income, which is $3 million. Okay. Now, when people take out term policies, often they take it out for like 10 years, maybe 20 years, because it's cheaper. Because it's cheaper, right? Which means 10 years down the road, assuming they're still healthy enough to qualify, and assuming they're still healthy enough to qualify at the best rate, both of which are questionable, right? You have to take out another term policy and pay more, right?
Right.
So the most cost-effective option in the short run always ends up being the least cost-effective option in the long run, right? It's just like procrastinating, okay? So a 30-year term policy costs more than a 10-year term policy annually, but it costs way less over the full 30 years, right? And just take that to its logical conclusion and you get whole life, right? It covers
Right.
you for your whole life, and it's the most cost-effective option in the long run, right?
Absolutely.
So in this case, I'm going to just keep it simple. We'll do a 30-year term policy, even though that's not what most people do. Okay. And that will cost you about $2,100 to cover just the husband because he's the income earner. You should cover both, but again, we're just going to keep things simple here. Okay. Okay, so that's pretty straightforward. So $2,100 a year for 30 years means over the next 30 years, you're going to pay $63,000 in term costs. Okay. So that's $63,000 that permanently leaves your personal economy that you cannot spend or earn on or do anything with. It's gone. As you mentioned, Peter, it's better than a 98% chance that that term will not pay out, which is what you want. You don't want to die prematurely. Okay. So, all right. And you can read some of the text up here. Okay. All right. So, what is the opportunity cost of that $63,000? So, if you had saved or invested those $63,000 over 30 years, what could you have earned on it? What could you have earned on, right? So this is part of the hidden cost, right? Opportunity cost. Something that's really important when we're talking about whole life insurance and especially infinite banking. We're recovering that opportunity cost, and this is an invisible cost that you don't see, right? So what could you have earned on that money? We're going to assume just 5%, right? So, and a lot of people will tell you you can earn 8 to 12%, maybe. Okay. But I'm going to say, what can you safely earn, right? Let's say 5%.
Net
Okay.
of fees.
Yeah. Yeah. And taxes and all that stuff, right? Okay. All right. So this is the lost opportunity cost. Okay. So that brings us to $146,000. So in this particular case, since we did a 30-year term rather than 10-year term, the odds are a little better. You might die between the ages of 35 and 65, but still pretty good. You're going to outlive that. So there's an 85% chance that you will outlive that term policy, right? So $63,000 was the out-of-pocket cost, but when you include lost opportunity cost, it comes to $146,000, right? That's a more comprehensive way of viewing what it's actually costing you, right?
Yeah.
Not $63,000. It's $146,000 with a fairly conservative cost of money, right? Okay. Again, the cost of term life insurance never ends. This is important to understand, right? That opportunity cost continues until the day you die, right? If you had saved on that $63,000, it would still be earning for you from now until the day you die, right? It's not going to stop earning for you if you had it, right?
Right.
So opportunity cost compounds over time, right? So let's assume for the moment that they both die at age 85, which is roughly, probably the female would live a little longer, probably to age 90, but we'll just say they both live to age 85. Okay. So that means if we take it out to the lifetime, the lost opportunity cost now comes to $388,000, right? So the actual cost of this 30-year term policy over your lifetime, when you consider the premiums paid and the lost opportunity cost, is $388,000, right? Most people are just looking at the monthly premium, right? They're not thinking big picture. Okay. So you lost $388,000, most of which you didn't see. And that's the problem. We tend to manage things that we see quite well, right? People obsess over getting the lowest possible interest rate on their mortgage, which, okay, you should try and do that. I understand, right? But there are other things that may have a much bigger impact to your financial life that we don't really manage as well because we don't see them. We don't see them, right? And this is why I actually like using policy loans against whole life insurance policies to finance purchases rather than paying cash. Because when you pay cash, there's a hidden cost to paying cash. It's called lost opportunity cost. Okay, but you don't see that. Whereas when you take out a policy loan against whole life insurance, you are being charged interest on that policy loan and you can see that. So it's good. It helps you to be more disciplined because it turns an invisible cost into a visible cost. And when we can see something and measure it, we tend to manage it better. And that's good. That's good. Okay. And you could even carry this out to your heirs as well, right? It's not just you. That's money that could have gone to your heirs and it would keep earning. So really lost opportunity cost compounding never stops. Okay, so there's our $3 million death benefit. In this case, we're assuming that you outlive the term or that you both die at the same time, right? So there's no death benefit that would have paid out to the survivor. Okay, so 388,000. Let's back up a step, right? What if what if you die not at age 85, but let's say age 66, right? Your term expired. It was a 30-year term policy. It expired, right? So you die, but you have no life insurance in force, right?
Yeah, but they tell you that you're going to be rich by then.
Right, right. I don't want to base my financial planning on a probability. I want to base it on certainty, right? Maybe you'll be rich by then. I hope you are. Would it hurt you to have a $3 million death benefit, right? Either way, it makes sense. If you're rich, then you can afford a $3 million death benefit, right? In whole life, right? And if you're not rich, man, you need it, right? So either way, it makes sense,
By
right?
the way, I never met anyone who had a $3 million whole life policy that was poor.
Mm-hmm. Mm-hmm.
Have you?
Um, well, see, my clients take out very large whole life policies for infinite banking. So I have clients who have over $3 million in whole life death benefit who are on the path to becoming rich, but they're not rich yet. But see, they're guaranteed to be worth 3 million.
Yeah, but they always have, but the way you build it, they still always have access to that money. So technically they're not poor because if they needed additional
No, they're
money,
not poor. Definitely not poor. Definitely not poor. No, no, no. I guess it depends how you quantify they're rich. uh, I think they're going to end up very wealthy because they're making the right financial decisions now, right?
right? And they're never going to be harmed by any of the bad stuff. And as a matter of fact, they'll still have complete access to that money so they can take advantage of every single government, Wall Street, and bank screw up for the rest of their life, right?
Yep. I have a client. Um, she's doing infinite banking with her whole life policy. Between her and her husband, they definitely have over 3 million in whole life. Okay. She used policy loans to pay off all of her credit cards. Okay. And started making those same repayments that she was paying to Wells Fargo. Now she's making to herself. Right. So she recovered all that debt. Okay. And all those payments that were going to the banks are now going to her into her policy. They just took out a policy loan to make a down payment on an investment property. Right. They're financing that down payment from their own banking system. So they're making money on the investment property and they're making money in the whole life policy from financing it. Right. So yeah, a little bit of a rabbit hole there. But look, 3 million, okay. It's really important to understand when you're talking about life insurance, millions, it's not a lot. Okay. It's not a lot. It's really not. If you die prematurely, $3 million, if you have a wife and children, I mean, how long do you think that's going to last them? That's barely enough to survive, right? Um, remember, no insurance company ever promises to make you whole. That's not what insurance does. No life insurance company ever promises to make you whole. Set aside even the emotional loss, just from a financial perspective, they do not promise to make you whole. They promise to limit your losses to something manageable, right? That's why they have deductibles. They don't want you to be incentivized to file a claim. They don't want anyone to profit from you filing a claim. So in this case, they don't want anyone to profit from your death, right? Your wife and children who survive you, they are not going to profit from this. This is going to allow them to continue to live at their current lifestyle, their current needs. When you get into a car accident, you total your car and the insurance company pays you that claim. Do you think they're going to overestimate what your car is worth?
Not likely. And I can
If
vouch
anything,
for
they're going
that.
to underestimate it. So when the experts, the actuaries at the life insurance company tell you your human life value is $3 million, you know they are underestimating your human life value, right? They're telling you your full earning potential for the entire rest of your life is $3 million. Well, that's ridiculous, right? They do it because they got to manage their risk level, right? They got to manage the risk level. What they're saying is you make $100,000 a year, we'll project that out over 30 years. So we're assuming you get no raises, no increase to your income ever, and that you retire at age 65, both of which are unrealistic. Most people, their income goes up, and most people don't retire at age 65. They keep working, right? So they are underestimating your human life value of $3 million. Okay. And if you think $3 million is a lot of money in terms of death benefit, you should watch Tom Hegna, The Widow Who Thought She Was a Millionaire. She had to explain to this widow who inherited what she thought was a lot of money from her dead husband how she was going to have to live below the poverty level.
Yeah, I think he was making $250,000 a year, right?
Yeah, so she was talking about building a custom built house and all that, and he asked her, "Can you live off of $30,000 a year?" And she said, "No." He said, "Well, you better learn to do that, or go back to work, or go to work. You're
Yeah,
gonna have if you want this money to last, you and your children are gonna have to live off $30,000 a year, right?"
right. That's a
Okay,
good story. You can actually go on the YouTube. I think it's go on the
yeah, I'll
Tom
put it in the
Hanks.
description.
Okay.
Okay, so just to back up and reiterate, so you died age 66, okay, and your wife survived you. It's pretty likely your wife is going to live longer than you. Okay, 3 million. Now what? Whoa, 7.5 million. What happened there?
That's a big number.
Well, when you died, your spouse should have gotten a $3 million death benefit, but she didn't because you bought term and that term expired. During the years that you're more likely to die, obviously, the younger you are, the less likely you are to die, right? So here you are, you die in your 60s, your late 60s, okay? Which is more likely you're going to die then than in your 40s, right? So she should have gotten $3 million. If she had gotten $3 million and earned just 5% on that $3 million, right? By the time she died, she would have had $7.5 million, right? That's the 3 million plus the lost opportunity cost. So it's not just 3 million.
And by the way, does that even take into account that they lose a Social Security paycheck?
Right. And she goes into a higher tax bracket.
Right? Yeah. She's going to file single versus married filing jointly.
Right. So many things that people don't consider when a spouse dies, right? You lose that spouse's social security check in old age, right? And cruelly, the widow now gets taxed at a higher rate because now she's filing single rather than married filing jointly, right?
Yeah.
All right.
So you add in the Social
This,
Security, you add in the Social Security, right?
Mhm.
You're you're probably you're pushing close to, let's just say it's, now they get to keep the bigger check. So let's just say the smaller check, I don't know. Let's say it's 15 grand. And he died at 66 and he was going to live till 85. So let's just say 20 years
30,
times 15,000. What's that?
three hundred
Three.
thousand dollars,
Yeah.
$300,000. And that's not including the lost opportunity cost either.
And that's not talking about COLA, because COLA, the cost of living adjustment is going to go up, right? Even in
Mhm.
like this year, I think they're talking it's going to be about 3%. So this number would actually be closer to what, 8 million? Of
Yeah,
8
again,
million.
I mean, it's all those hidden costs, right? Whole
And then the
life insurance
taxes.
helps you to avoid all of those costs that people don't take into consideration. Like when they project out these wonderful returns in mutual funds, which is pure fantasy, it's all just ridiculous advertising. They don't take into account fees, they don't take into account taxes, right? They don't take into account the way that this impacts every other area of your financial life. Like when you go to apply for financial aid, well, that counts against your assets, right? So you don't get financial aid. With whole life insurance, none of that's includable. It's protected from creditors. There's no taxation, right? It's not interrupted when you borrow against it with a policy loan. So if you need to raise your money in the market, there's a huge opportunity cost because that money is no longer earning for you. Not so with whole life. If you get a chronic or critical or terminal illness, that's going to blow a huge hole in your plan unless you have whole life where you can use that death benefit to pay for it, right? And again, this isn't necessarily to talk about term versus whole life because Peter and I agree it's not term versus whole life. It's convertible term and whole life. Both are good and they work together. It's more about helping you to understand all these hidden costs that people don't consider, right? You
Right.
have to look at it within the context of your overall financial picture, not just in isolation. And you can't be focused on what does it cost. That's only one small piece of the equation because you're talking about what is the visible cost, right? Not what does it actually cost.
Yeah, I like this. This is good.
So there you go. Total premiums and death benefit to survivor life horizon, right? So the total cost of that term policy was almost $8 million. Almost $8 million. But I thought term was the cheapest option, Peter.
Well, what do they say? You pay for what you get.
Yeah, I mean, it's kind of like what I say, the product that has the lowest advertised cost is always the most expensive and the lowest quality, right? Over the long run. Again, just think about all the stuff you get for free, quote unquote. All that stuff you get for free, right?
Yeah.
Um, so again, term is the most expensive form of life insurance that you can buy. Whole life is the least effective form of life insurance that you can buy. This little term policy with a $2,100 annual premium cost you almost $8 million when you consider everything about it, right?
Yep. That's why George Sigurdsson likes to say that whole life is the greatest non-managed asset ever invented.
Yeah. Yeah.